concept: venture capital. Venture capital is a financial tool that allows entrepreneurs to sprint towards success by buying out the failure risk of their startups. Can the failure risk of entrepreneurship be bought out? Wang Xing, the founder of Meituan, started around 10 projects between 2004 and 2010, all of which failed. After 6 years of repeated failures, Meituan finally succeeded in 2010. What about the failed projects before Meituan? Does Meituan need to pay for them? Of course not. Wang Xing bought entrepreneurial insurance from venture capital for his previous projects. If the project fails, the venture capital takes the loss, and Wang Xing does not turn the failure into debt and carry it into his next venture. However, Wang Xing paid a high price for this, which is a large share of the wealth he would receive if the project succeeded. Application: the wisdom behind if success. Free and even negative cost have become a basic form of the internet. This has left traditional companies, which have always relied on their own funds to develop, very puzzled and worried. Where does all this money come from? What if they don't make it back? If they don't make it back, will they go to jail for private asset loss? In the lesson on network effects, I shared with you why internet companies are so crazy. Today, we will talk about why they dare to be so crazy and the rational force behind all this apparent madness: venture capital. Venture capital, to outsiders, seems like an unreliable game of gambling. However, every investor can tell you a unique method for judging whether there is a gemstone inside a rock. But no matter how unique these methods are, the most essential aspect is still a game of probability. The biggest advantage of the internet is its efficiency, which uses extremely low marginal costs to gather a huge user base that traditional companies cannot imagine, breaking through the tipping point, achieving a winner-takes-all situation, and obtaining huge profits as a result. Investing in Alibaba, JD.com, or Xiaomi can yield returns of tens or even hundreds of times. But what if it fails? The early investment yields nothing. In fact, this is the most probable outcome. In other words, you may have a 1% chance of earning 100 times the investment return, but there is a 99% chance of yielding nothing. Venture capital takes the money burned by 99% of companies as a cost in exchange for the less than 1% chance of hitting the next Jack Ma. Therefore, venture capital is actually a rational gambler who bets on startup companies. Various unique methods, such as judging trends in teams, are all secret techniques to increase the probability of hitting a royal flush. The difference between these secret techniques ultimately lies in who can increase the success rate of less than 1% to 2%, 3%, or 5%. If entrepreneurs have the craziest hearts, investors have the calmest minds. Based on this game of probability, investors have designed a complex product system for entrepreneurial insurance, such as Angel, A round, B round, C round, and so on. The later the round, the lower the risk and the lower the rate of return. Summary: remember a few things. First, always remember that entrepreneurship is a game of 99 deaths and 1 life. If you want to start a business, it is recommended that you do not use your parents' retirement money, but instead keep the money for your family's living expenses and find venture capital to buy entrepreneurial insurance with diluted shares. Second, every entrepreneur believes that they will succeed, but most end up with bones as dry as 1,000 trees. If 10 investors do not believe in you, it may be because they lack vision, but it is more likely that you are not reliable. Use their experience to correct your views, and don't fall in love with your own PPT. Third, financing, and even going public, are not signs of success. These are just the beginning of a new stage. Profit is the meaning of a company's existence, and customers and products are the core of profit. Treating venture capital as a business model is similar to cheating insurance. Fourth, also remember that once you have financing, the company is no longer entirely yours. When your pace does not meet the expectations of investors, you may wonder who the boss really is. This is why some people buy back their companies in anger.